Hello, welcome to AleaSoft webinar. My name is Alejandro Delgado, Technical Director of AleaSoft and Associate Partner of Alea Green, and thank you for joining us today to the webinar with the topic Prospect for European Energy Markets in the second half of the year, Renewable Energies Financing and PPA. Our first speaker today will be Oriol Saltó, Data Analysis and Modeling Director of AleaSoft and Associate Partner of Alea Green, that will discuss about the evolution of the European energy markets and the prospects for the coming year, the coming months. Then we have two speakers from Engie Spain that have joined us again after 1 year from our last webinar together, and that we talk about the financing of renewable energy projects and PPA and the main regulatory issues of the Spanish electricity sectors. The speakers will be Daniel Fernandez, Strategy, Regulatory Affairs and H2 Director, and Ignacio Sáenz, Head of Origination and Sales. If you have any questions at any time during the webinar, please use the Q&A menu and we will answer them after the presentation. And now, I hope you enjoyed the webinar. Oriol, please share your slides.
Thank you, Alejandro. Good morning, everybody. As Alejandro mentioned, I will be covering the first part of the webinar, talking about the European energy market and how they've been evolving during the last weeks. Our last webinar was 4 weeks ago, and in some slides we will be comparing how are the markets right now compared to AleaSoft and the services that we are offering. In case you don't know us, in AleaSoft we offer forecasting services for the energy sector. We are covering all the European energy markets, and we are also expanding globally. We are also covering some energy markets in South America, also some markets in North America, and we will be expanding also to the Asian markets. This is the 24th anniversary. This year is the 24th anniversary of our company, and our goal by the end of the year is to fully cover the 35 European energy markets. This means covering short, mid, and long term for all markets: electricity, gas, renewables, demand, etc. We forecast basically any variable that can be interesting for the energy sector. Obviously, demand and price for the energy markets, but not only spot markets, but also ancillary services and also futures markets. We obviously make a forecast of renewable production and also production for conventional power plants. Also variables that are interesting for the sector: weather conditions, socioeconomic indexes, CO2 prices, fuel prices, oil, gas, etc. And we not only make deterministic forecasting, but we also make simulations. We have hourly price simulation up to several years into the horizon. The methodology that we use for forecasting is our own methodology. It's a methodology that we ourselves developed in AleaSoft, specifically for forecasting in the energy sector. The main 3 points that we always like to stress about this methodology is that it is a completely scientifically based methodology. It's based on statistical models, on neural networks, and it's a hybrid technology that combines several forecasting technologies. This scientific base of the forecast gives us very consistent results and forecasts that keep the coherency over time. The consistency and the stability of our forecast is one of the main points that our clients appreciate about our technology, and this led to building a strong relationship of trust with our clients. And well, it's a technology that we have been using for 24 years now, starting in the Iberian electricity market and now covering all the energy markets in Europe and beyond. As always, I will start with the oil price. Oil price is kind of the index about how the global economy is going. And what we are seeing, it's since the beginning of the year, or even if the last month of the last year, basically prices have been relatively stable. Basically because there's a lot of uncertainty, mainly on the demand side. So we just saw this week the forecast for the global economy for this year and the following years, and they are, let's say, forecasting a very slow growing economy at the global level. So basically the demand for oil is kind of uncertainty that it will increase in the following years. And all this uncertainty, basically, it's being offset by all the cuts that are being announced on the supply side. So recently this week, or by the end of last week, Saudi Arabia announced that they will cut their production beyond, on top of what they were already cutting, an extra 1 million barrels per day, starting now. And basically, this has been offset for the uncertainty on the demand side. So basically, if we look at the cut announcement, the announcements that we've seen in the last years, we see how they somehow at the very short term produce some kind of impact on prices, but basically as the demand side is not responding, basically we see no further effects, and we see how the last announcement had basically little or no impact on the prices. So for the following month, basically uncertainty, no clear trend. It's really seen on the prices right now. On the other hand, for the gas prices, on our last webinar, we saw how the floor that we had at 40 euros megawatt hour was clearly broken, and now prices are at the level of 25 euros megawatt hours. Prices went down to 23, I think, but still this new floor, it's not clearly broken. Probably it will be in the following weeks, but for now we are at this 25 euros megawatt hour level. And if we go back, this is the level of prices that we had in May 2021. So 2 years ago, just at the very, very beginning of this energy price crisis. And these are the prices also that we had back in 2018. So we can say that we are more or less back at the levels previous of this energy crisis. If we look at the storage levels that we have right now, we are barely starting the summer, and we are already above the 70% of the storage capacity. This compared to the last year, in this time last year, we were below 50%, and we were facing critical summer, and we know the prices that we registered last summer. This summer expects to be much easy in order to end up refilling all the needed gas for the following winter. So at least for the next month, gas prices seems to be we can expect no new gas price peaks unless as always, we are kind of very expectant on the geopolitical situation, but at least we know that we have something to support the prices that are the storage level that we have right now. And recently, the European Union finished their joint gas purchase. They first joint gas purchase, and for the aggregated demand that were participating in this first tender, they were around, yeah, there was 13,000 billion cubic meters. needed of demand from European European companies, and the supply offers basically covered most of this. Then these supply and demand offers were crossed, and I think nearly 10,000 of these offers were matched, and now each contract has to be negotiated between the two sides, the exact conditions of each contract. And from these offers, 80% were pipeline gas and 20% were LNG. If we look at the CO2 emission rights prices, what we saw in our last webinar was that the last attempt to break this ceiling of the 100 euros per ton, that it's been here for forever, was really looking that it was not going to be broken recently. And what we are seeing right now is basically that prices are retreating, getting farther and farther from this barrier. So at least for the next month, we don't expect this barrier to be crossed. At the long term, it will be crossed at some point because this market is designed to have prices increasing at the long term, because it is a tool to incentivize the switch from coal and gas and fossil fuels to cleaner technologies. So basically, in order to incentivize this switch, prices need to go up at the long term. But for the following months, it looks that prices are difficult. It's difficult that the prices in the coming months will be crossing this barrier of the 100 euros per ton. If we look, I didn't prepare what I needed. Let me check for a second. Okay, for the following, for the electricity markets, I'm going to show them in our online platform. Let me switch the screen. Okay, here it is. Okay, so let's see how the electricity markets. I'm going to show the monthly average for the last month. So let's put them since 2020. Okay. Prices. Okay, sorry, because I didn't remember that I need to prepare this and these slides. Okay, just let's see how these markets will basically. Let me go back here. Okay, so in the last month, so the last full month that we have of energy prices, it's May. So comparing May to comparing May with April, basically all the markets has decreasing prices. They are basically following the trend of the gas prices. So on average, if we, with the exception of the Spanish and the Portuguese markets, so with the exception of the Mibel market, on average, the European electricity market went down by 22%. This is basically the case. And if we'll take a closer look at the prices during the last month, let's go to March. Basically, prices, you can see this slowly downward trend following the trend of gas prices. Basically, also renewable energies, wind energy is decreasing a little bit because seasonality it's decreasing for the wind production, but for the solar production it's increasing, so it's also pressuring down the electricity market prices. So basically, following the trend of the gas prices, 22% down on average on electricity market prices. Okay, now let me go back, switch back to my slides. And here they are. Basically, remember that this is our online data platform. It's a service also that we offer to our clients. So information is power. So having all the data needed for any player on the energy sector, having all this data in one place, always updated with a given format and easy to manage, to download, and to perform some analysis. Also, in our web page, you can find all the other reports that we are making on energy markets, long-term reports. These are the most demanded markets. Also, analysis on specific topics on energy markets, reports on PPAs, on the future of the energy sector, also analysis on individual plants, not only at the market level, but captured price or production profiles for a given location or for a given plant with a given technology. We also make individual analysis for individual power plants. And now let's take a look into the futures market. What are they saying about what the market agents are seeing right now about the future? And this is the forward the forward curve for oil futures. Basically, as we saw that the spot prices are basically very stable, around $80 per barrel. Basically, we saw no changes in the forward curve. At the very long term, a little fall of around 4%. But basically, no changes. This is compared to the forward curve that we saw in our last webinar, that was 4 weeks ago. On the other hand, if we look at the gas forward curve, basically, as spot prices are decreasing with a constant trend, we also saw this important fall in the forward curve. So the futures for the remaining on 2023 and 2024 went down by 25%. That's a lot. In this scale, because we have these historic very high prices, it doesn't look important, but it's 25%. So it's a lot of decrease, and then decreases along the horizon, 18% for 2025, 12% 2026, and for the rest of the horizon around 9%. And if we look as I said, we are now basically already at this 25 euros megawatt hour. It's more prices that we already had in 2018. At that time, those were very high prices. Also the prices that we had in May 2021. And if we look into the horizon, the futures are telling us that around 2027, 2028, this is more or less where we are going to be back to these gas prices. So if this is going to be the new normality, we will be back to normal prices around 2027, 2028. That is more or less what we were seeing in our last webinar 4 weeks ago. For CO2 prices, basically, as spot prices are decreasing, the forward curve is also decreasing 8%. The forward curve is usually very rigid, so it basically moves with the spot prices with a very straight line. And basically, we are seeing a constant decrease of 8% along all the curve. If we look at the electricity futures, basically, we see a decrease following also the decreasing gas prices. Most important decrease in Cal 24, 12% in Spain, up to 25% in France. That is the largest change. But also we see some decreases at the very long term. So 13% down in Italy and Germany, and 7.4% down in Spain. And as always, a reminder that this futures markets at the very long term are very liquid markets, so it's barely impossible to trade any energy at these horizons. And also a reminder that these are, as they are very illiquid, they are not a very good price signal for the future prices of the spot market. So they are forward curve, they are not a price forecast. And let's take a look at what we are considering now when making forecasts, and also as a summary of what we've seen in this in the previous slides. Oil prices basically remain stable with some volatility, basically because there is no clear trend on the demand for the following years. Gas prices continue with a clear downward trend, and now they are at the 25 euros megawatt level, and it will probably be crossed shortly, consistently crossed shortly. CO2 prices are retreating. They are moving away from the ceiling of the 100 euros per ton. And electricity markets are basically following the gas, the trend of the downward trend of the gas prices. In the midterm, gas futures tell us that still this fully return of the prices to the normal or the new normal levels will be around 2027. And at the very long term, changes are basically, things are basically unchanged. Prices will be driven by renewable energy production, energy storage, green hydrogen production, and also the hybridization of all these different technologies will be very important and playing an important role in markets and determining their prices. And just let me finish inviting you to our next webinar that will be in July. I think they are 4 weeks from now in July, and we will be talking about again revising and reviewing how the energy markets are doing, and also we will be talking about methodologies for long-term forecasting, seeing what are the keys for the energy transition, and also what's the state and how important are long-term forecasting for financing or finding finance for renewable energy projects. Thank you, Alejandro.
Thank you very much, Uriol. Very interesting, as usual, your presentation. And we will just take a few minutes because well, Daniel and Ignacio are having technical problems. They will join soon to continue with their presentation. Just please wait a minute.
We still don't have any questions in the Q&A menu in the application. Please, if you have any question, just write the question there. But we have some questions that arrived previously by email. It's also another way to make questions, to prepare questions. So if you, before the webinar, want to send questions, you can do that. Alejandro, if you want, we can take the opportunity to answer some questions, the ones that we received by email.
Yeah, of course. Go ahead. Danny just told me that they will be connecting soon.
Okay, just cut me whenever it's they are ready.
Yeah, of course.
Okay, a very interesting question. So we had some questions about the Spanish market because there will be general elections in July. So they were they've been the next election were expected on December, and now they they advanced them in July. So it's been a very interesting, are very interesting times in Spain, because also a change in the government, it's likely expected. So there are high probabilities of the color of the government changing in Spain. And this could mean a change in energy policy, because it's one of the main topics, as we have been in an energy crisis. It's one of the main topics. So how one of the questions, or several of the questions, were about this possible change in energy policy and how it's going to affect the energy markets, electricity markets mainly, or the electricity market in Spain. So basically, as we are in an European electricity market where all the markets are working with the same rules, all of them are interconnected. So basically, even if the energy policy of one country changes, the market structure, the market functioning, more or less, it's going to be kept as it is right now, because any important changes in the energy market, in the energy function, in the energy market rules, they have to be agreed among all the European countries. So basically, we don't expect much changes in the electricity market, but there could be changes in, for instance, in renewable energy policy, and how they are going to incentivize the installation of new renewable energy capacity. In Spain, the solar capacity, it's increasing very, very rapidly. It's going even faster than what we have in our national climate and energy plan. So basically, now they are reviewing it because the 2030 targets have to be updated, because for wind energy, we are going slower than expected, much slower than expected. But for solar capacity, we are going much faster than expected. So changes need to be made in the 2030 targets. More questions. Let's see. Okay. Are they? Yeah, well, it's a question that we receive more or less in each webinar. Are the renewable energies and battery storage profitable in the Spanish market? So what we can say, looking at our projections, is okay. I see that Daniel is already connected. So if you are ready, Daniel, Alejandro, I think we can start.
Daniel, you are on mute.
Hello all. Apologies for the delay, because we have some technicalities with the Zoom. So that's it. And now we have. Give us 1 minute more, Oriol, just to be able to share the slides on our side, because we. Okay, let's. Sorry, because we were not able to find the proper link. Okay, so and okay, 1 sec. Okay, there we go. Now we share slides should come in 10 seconds. Okay, share screen. Yes. There we go. That's it.
Great. Yeah, we can see the presentation.
So hello all. Good morning. We are here. My fellow colleagues, Ignacio Sanz, our head of PPAs and then sales for energy management, and also with Julio Nieto, our head of regulatory affairs, and I'm Daniel Fernandez, head of public and institutional affairs for Engie in Spain and corporate strategy. It's a pleasure to participate again in the ALEA webinars, and well, what we have brought here to you guys, some slides, basically to explain you what is Engie doing in Spain, and why we are believers of the energy transition in Spain, and why we consider Spain is the place to be for renewables in Europe, and also profiting from the fact that Europe is moving ahead in the EU market reform. One key element of that reform is PPAs. Spain, as you know, as of 2018, is mastering PPAs in Europe. And we want to share with you some considerations on why PPAs are really a kind of cornerstone, or a kind of, let's say, El Dorado in the current business environment. So basically, this is what we have brought for you today. You have there in the slides our emails. Please feel free to contact us either now in the chat or later in the Q&A, or through email, or even through LinkedIn. We are here at your service and to help. And the idea is to contribute to generate some knowledge around the status of the Spanish energy market, the status of the energy transition in Spain, and why Engie considers that the Spanish market is very attractive for renewables. So basically, 1 minute for Engie in Spain. Basically, we are an industrial company. We are present in Spain as of 25-year-old in terms of wholesale markets, and more than 70 years in terms of industrial capabilities. And we are an industrial company to decarbonizing ourselves through renewables. We have our DNA coming from Gas de France and from the historical utility gas environment. We are very proud of our DNA, but we are progressing and we are transiting towards renewable. So we are an industrial company that decarbonizes through renewables, and also through decarbonizing our clients, providing a range of solutions in terms of facilities for decarbonization. So basically, what we have in Spain today is 1.7 gigs of renewable, most of them wind. We have 2 gigas of flexible generation, low in CO2, giving back up to this renewable. And also we have a variety and a myriad of different assets. We are incumbents in district heating and cooling networks in Barcelona, Zaragoza, also Palencia, Pamplona, we have Frex in Madrid, etc. And we are providing self-consumption thermal and PV and CHP solutions for industrial clients in a range of sectors. Finally, we have strong competences in terms of trading, energy management, portfolio management, because our 3 businesses, solutions, renewables, and flexible generation, cannot exist and cannot be managed without energy management and trading. And thanks to that energy management and trading capabilities, we are originating, we are providing PPAs, we are providing different products on that, specifically PPAs. So basically, that's what we are doing. Comparing with our competitors, we are behind the incumbents, but we are on top of all the new entrants, fighting a lot with the oil companies. Our ambition is to go to at least double this amount of renewables, this 1.6, double it for 2026. And well, try, why not, to let's say, compete face to face with EDP in the position in Spain. Obviously, its competition is fierce, not only with the companies you have here, but also new entrants. But that's part of the game, I would say. And well, this is where we stand, and this is why we consider we are entitled to be here and share with you our thoughts. 5 years ago, we have nothing on renewables, or only 65 mega. We believe in this market, not only now, but also 2 years ago, 3 years ago, we negotiated this acquisition that provided us 900 mega one shot by the acquisition of Veolia. So we are not PowerPoint financing. We are not announcing that. No, we have a real industrial project behind, and these assets are there. This is an example. Why Spain is the place to be for renewables? Well, basically, we try to sum up here why we have grown from 65 mega to 1.7 giga in renewables in 5 years, and we are targeting to double by 2027. Why? Because of the natural conditions of the market, the know-how and the industrial value chain existing in Spain, the attractive position of the market in terms of the expectation from the generators and the demand, the facility for financing and the role of PPAs, and the very strong political commitment that we can see in the generation mix targeted by the existing PNIEC, National Energy and Climate Plan, and also with the forecast that we can envisage for the next PNIEC. It seems that at least we will have 10 giga more of each technology in 2030, ranking 60 giga for wind and 50 giga for solar. So there are strong natural, social, banking, political conditions that explains Spain is the place to be in Europe in terms of developing renewables. Obviously, we cannot say that this is a kind of Alice in the wonderful world environment. There are problems, there are challenges that has to be solved in order to let Spain remain as the place to be for renewables. Here we have tried to list some of them. Due to the time, we don't have we cannot enter in major details, but basically there are different families of problems. Maybe the biggest ones that we see here in purple is the big problems in terms of permitting, getting permitting for connection, for environment, timing, resources in administration, ordering the sector, because as you know, there are already 120 giga of permits awarded for 60 giga growth in the PNIEC. So at some point, something needs to be adjusted. There are major uncertainties in terms of how many projects are going to reach construction permitting this summer. It may be the case that we get 70 giga of permits that will have to be commissioned in 2 years, 2 years and a half. Honestly, we have never been able to commission more than 7 giga years. So building 70 in 2-3 years, it seems it is at least ambitious. So there are a lot of things to tackle there. Also, other problems related to the market design. We have seen this spring major cannibalization following the massive penetration of PV and the self-consumption. What's happening with that? Developing batteries. In order to develop batteries today, you have the same permits for a generator. And indeed, batteries that are providing grid support at many times. So maybe something has to evolve there. PPA structure, something has to evolve there, because clearly this macro volatility environment is changing a lot the patterns and so on. Due to the cannibalization in the market price, there are a lot of local constraints. Should we switch at some point to another market or not? It is the fact of having a single node, it's less and less true, or at least you can suffer a lot. The proper regulatory evolution, what's going to happen with the EU market reform and how to apply it in Spain, and a fierce competition. It is not only the cannibalization in the market, but also a big cannibalization that we are seeing even between utilities, oil companies, new entrants, investment funds, etc., etc. There are many issues to tackle. Even for the last year, there are issues related with social perception of renewables, and NIMBY movements are starting to come in Spain. So basically, the issue here is that we have a sector to put together the problems. And I don't know, Juli, if you want to add something on something to highlight, or what problem you consider the most relevant one, maybe?
No, today I think the cannibalization of the PV plants and the day-ahead price in the solar hours. This is a problem that we are seeing last month in the weekends and in Easter dates. And from a point of view, this is a problem. The idea is try to move the demand of the consumption to this hour, increase the demand in this hour in the PV hours, in the solar hours. And the government have to take some measures trying to move this demand of this hour, because in other case it will be not possible to withstand all the PV capacity that they want.
Clearly. No, I fully agree with you. And then indeed, this is more or less what we are tackling in the next slide. So basically, in this kind of events, obviously it is not only about put into their problems, but also try to put on the table some solutions. So basically, maybe the mantra we are perceiving today in associations when discussing with the ministry, it is true that now we have this specific electoral context, but it seems that we have to wait for everything to be solved, that when the EU market reform comes. Let's be realistic, it is very unlikely that the reform comes this year. Moreover, in the next year, the Parliament, the EU Parliament will close early March because there are elections on June 11. So honestly, it is very urgent to take action now, and we cannot wait for EU market reform to tackle all these problems. Indeed, the problems that Julio has just pointed out related with the market prices and the DAC curve and the cannibalization of prices in the daylight, it is something that it can be tackled now, maybe fostering batteries, fostering permitting for batteries, or avoiding batteries to improving the timing, or avoiding the batteries to pay grid costs, or switching the PPA cost, for example. So that's a problem related to the market evolution that can be tackled now, not only for the batteries and for the flexibility, but also for the adequacy. We have a draft ministerial order as of 2 years ago for flexibility, for adequacy, etc. Nothing prevents the Spanish government to develop that, to give more room for batteries, and therefore to solve that constraint now. In terms of permitting, in terms of putting order on the rhythm of penetration of this new capacity, that's something that can be tackled perfectly now. We are, as of the Royal Decree 23/2020 for transmission rights and so on, we are trying to order this. Okay, the measures can be put together already in terms of timing, in terms of maybe maximum penetration of technology per year, per nodes, etc., etc. Let's see what comes with the PNIEC, but we need a PNIEC that it is realistic, not only in terms of targets, but also in terms of grid evolution to back up that PNIEC, and also in terms of real economic development and real operational development. And then also, trying to incentivize the demand and providing and giving demand more elasticity. Why? Because at the end of the day, we can end up in 2-3 years with a mix much bigger than what we need, especially with the amount of self-consumption which is entering nowadays. So what we see from the problems is that these 3 areas that can be tackled, it is not sequential. These issues, they can be tackled on a parallel track basis. There are examples quite clear, for example, in the sense that concerning batteries, why batteries are evaluated as a new generator in the most constrained case of the network, because in many cases they are providing energy and therefore they are helping the network, not constraining the network. So basically, this is what we see, and this is our message in terms of issues that can be tackled before adapting ourselves to the EU market reform. Indeed, in the EU market reform, it is what it is saying is just the principles you can see here, that capacity markets are needed. In Spain, we already noticed that before the commodities crisis and before the Ukraine war. It confirms the spot market as key element, and this is something the spot market has worked very well in Spain for the last 25 years to develop the sector, so keep on with that tool, and then foster PPAs, foster CFDs, but come on, PPAs and CFDs, they were already existing in Spain prior to the proposal from the Commission in March. So basically, what we see on our side is obviously the reform sometimes is in the middle of nowhere, and obviously you need a European consensus. That's always challenging, but the reform is very good in terms of providing tools for evolution and not for a revolution of the market, and also putting the debate of prepare yourself for the future, manage liquidity, increase the roles of PPAs and the roles of long-term products in order to manage risk. And at some point, the reform is very good to put the energy in the center of the debate, and also to let generators and clients to be aware of the risk and improve the tools in order to manage the risk. In this regard, it is excellent that the role of PPAs liquidity in the long term, credit, etc., is highlighted, or it is, let's say, revamped or enforced by the EU reform. And this is, well, with all these problems, we consider that Spain keeps on being very attractive, is still the place to be with these uncertainties that for sure are going to be tackled in the upcoming years. And this is why 2 days ago we purchased 122 mega of projects that permitting will be concluded in the upcoming months, and we expect starting construction before the end of the year. So this is again a proof of fact that Engie believes in this market. So basically that's from a general perspective. And now, Nacho, I give the floor to you, because as I was telling before, the EU reform, let's say, entrusts or enlightens or gives more visibility to the role of PPAs. So therefore, the question is why PPAs are needed or are relevant. So if you can share with us some elements on that, great.
Here we are. Hello, guys. We have prepared a presentation, not a pure presentation, it's more or less a guidelines talking about PPAs and the renewables markets in Spain. First of all, we would like to, just a second, first of all, ¿puedes pasar dos? No pasa.
Sorry.
First of all, we would like to discuss just a little about if a PPA destroys project value, yes or no, and which are the drivers we should take into account in order to answer this question. Okay, so so the first thing is that we would like to say is that when you jump into a renewable project, basically what you are putting yourself is jumping into a super long position. What is a super long position? You are a seller of a commodity, which is power, in a huge quantity. And why we say in a huge quantity? Because at the end of the day, if you are just a developer with 200 megs, 300 megs, for instance, solar capacity here in Spain, 300 megs times 2,000 hours means 600 gigs per year, which are more or less something around 70, 80 megawatts in base load. You are placing yourself in a long, massive position, which is massive because at the end of the day, if you look at the future market and exchange houses, clearing houses here in Spain, the volume negotiated in a given day in Spain for products on the year ahead is more or less something like 5 megs, 6 megs, 10 megs. So at the end of the day, if you are having a position of 80 megs long, you are massive in a generation position. So the first thing you need to take into account is, if I jump into a position, how I'm going to exit, where is the way out, what I'm gonna do to offload this energy. And now this is the topic these days. If we look at the national demand here in Spain for 2022, more or less it was around ballpark figures of 230, 240 terawatt hour, which those more or less, base load I'm talking about, more or less. So which those, the 30% was fulfilled by gas, 50% by nuke, and more or less the 50% was done by renewable. So at the end of the day, what is feasible to be taken by the demand is 120, 140 terawatts hour. If we look at January and the positive environment impact assessment declarations for different PV power plants, if I'm not wrong, Daniel has got a better figure than me, but it was like 50 gigs of positive environmental.
Yeah, even more, 50 at national level and a bit more. Yeah.
Okay, yeah. So 50. If we look at this and only the 20% of those are able to deliver, so we're talking about 10 gigs, again, same computation, 10 gigs, 2,000 hours is 20 teras of energy to be assumed by the market during 24 and 25. I mean, this is the 10% of the national consumption on solar profile, which let me say that is almost impossible. So the demand is not going to assume on the next year, on the next 2 years, something around 20 teras of solar capacity. So this is the end of the world that we used to know. Well, no, probably it's not necessary to sing the song, because the good thing or the light at the end of the tunnel is that only the 30% of the primary energy consumption in Spain comes from power sources, while the 70% of the thing is coming from fossil fuel generation positions, which means there is still 700 tera to be decarbonized and to be electrified. Okay, so cannibalization is there, backdack is there, prices are getting lower and probably will get lower in the next few years during the daylight hours. But let me say that demand is not stupid. It's not stupid and it's flexible. Probably it's not that flexible as we would like to be, but it's flexible. So probably we'll have an issue during 24, 25 by swallowing this huge quantity of PV capacity. But we are strongly sure that during 26, 27 onwards, the demand will recompensate themselves and will be prepared to assume much more volume. Being said this, I'm talking only about PV power plants. For sure, wind farms with profiles of production much more close to baseload solutions or hybrid solutions between PV and wind still has got a lot of room in the Spanish power market. Okay. So this is the context we would like to give. So until up to this moment, we were suffering about clear speculation. What I mean with speculation, because we used to form a theory or without firm evidences. What means this? That we assume that last profits that used to work in the past is going to work in the future. Yeah. So if you are long in as we said before, if you are long in a generation position and you feel comfortable with that the market will swallow it, I'm a super believer and a super defender of the theories of Adam Smith. Yes. But at the end of the day, the market is not going to regulate himself as it is. So we need to support the market. We don't do the speculation. So we need to understand which are the risks of our positions, doing a mapping of our risks. And while it's done the mapping of our risks, we could take decisions. Here we present you what is the map of a risk of a given project. So we have got different risks. I don't know ¿qué tal vamos de tiempo? Vamos bien. Yeah. So 7 minutes. 7 minutes. Okay. So we can spread them in different buckets. So for sure, market and financial risks are the ones that all of us are much more concerned about. But for sure, regulatory and legal risks are there. Operational risks are there, and something like health and safety things, how your company is perceived in terms of greenification and so on, are important for this kind of project. So we will face ourselves, or we will focus ourselves on the market of financial risks, and there are the risks that a counterparty or that a developer should handle, should create their own patterns and assume which are the risks that they want to handle or they want to externalize. So energy price risk for sure is there. Volume risk are there. We used to have products until 1 month ago, 2 months ago, 6 months ago on as produced basis, where the developers used to looking for a PPA with an investment grade, super handsome, blue eyes, long hair PPAs that probably is not going to be there for a while. So volume risk was offloaded. Swing risk was offloaded, balancing risk was offloaded on MRSA contracts for 10 cents. We have been seeing that on the last 2 years, those contracts assuming the 100% of balancing risk for 10 cents, 20 cents are not there anymore. And companies providing MRSA activities are asking for 3, 4, 2 euros for those kind of contracts. So again, we are Engie, we're a company that we manage risk. So we encourage you to do the same. Analyze your risk, define your risk, and decide which are the risks that you want to keep or you want to offload. Then there is a topic here that is super important, or two topics that are two faces of the same coin. So one is volatility and the other one is liquidity. So I'm a developer. I've got 200 megs of pipeline under development, and I fully understand that it will be ready to build and online, I don't know, by the next year, and we'll be producing energy by the end of 2025. So I'm really concerned about my permitting. I'm doing my best. I'm focusing my efforts in the permitting, because I see there is a market of PPAs right now, assuming as produced, so there is liquidity good enough in the market, but that would change, and this is changing. So liquidity is directly related with the price. Okay, why? Because as long as there is no off-takers, or the number of off-takers are reducing for PV volumes, the price is going to decrease. That's one topic. Second topic, volatility. Volatility is decreasing these days, but if you look at Ukraine crisis and so on, volatility was one of the trendy topics. So the more volatility is in the market, the more it's going to be impacted in the price. Why? Because I can see prices in the forward market in 100 euros, but me as an off-taker, I assume this is volatility, and I will place myself in situations of black swans and things like that. So I'm not going to pay 100 in such a crisis situation. So if you are thinking yourself by speculating that somebody's going to give you with the price that is in the market based on a prices of a super scenario volatility, probably you are wrong. Problems with the correlations and others. This is more related to gas probably, but cogenerators used to think that the proxy PV TTF was super good one for ensuring the revenues of their cogeneration assets. Again, Ukraine crisis come, TTF goes bananas, PVB stays where it's it, and the spread of PVB TTF that it used to be something like plus 20 cents, plus €1, minus €1, goes to minus 20. So again, one more risk to be handled. Pricing, volume, so we have talked about this, I think, good enough. We are almost hackers, as you may see. Balancing risks. This is something that is quite a trending topic for the last year. Balancing risk, as you may know, I've already talked about this. On MRSA contracts, balancing risk was something that was pretty such a commodity. MRSA providers were happy to have that balancing risk only for the sake of having the cash flows of the assets, when the pricing or the costing of those used to be something around 30 cents, 40 cents, and we're used to happy to provide 100% and balancing cost assumed by fees of €1. I think these do not exist anymore. So again, if we are preparing ourselves for the future and taking into account what we should do and which are the risks that we want to assume, probably to assume today a 5 years contract in a row, balancing risk 100% assumed by a service provider, it probably is not a better option because it's going to be super expensive. So probably rolling with the punches on short periods will be a much more efficient solution than going 5 years product. Credit risk, again, is a must. And well, supply risk. So the supply is there. As you may know, companies like Engie do not keeps all the volumes that we buy for ourselves in our portfolio. So normally we offload the 70, the 80, the 90% of those. So the supply is one of the main stakeholders that we should take into account, how the supply is going to accommodate themselves in the near future, and also educate not only the banks on financing things, not only developers on managing the risk, but also educating to corporates that probably the pure vanilla baseload product is a product from the past that do not exist anymore, and new solutions needs to be implemented. So we can deep dive on this, but I think it's not important. Probably you have got there, you have got these slides for the future. So at the end of the day, looking at the risk management, looking at the liquidity, looking at the volatility, PPA destroys value for a project. But it depends on your profile. If you are super conservative pension investment fund looking for a 1-digit profitability, no risk, investment grade investments, probably a PPA is your cup of tea. if you are a much more aggressive guy looking for 3-year solution, rotating assets and so on, probably PPA is not your best solution, but for sure, risk management is here. Companies like Engie are here, and we will try to support you on whatever you may need.
Many thanks, Nacho. Well, here you have the info for.
Danny, you are on mute. Danny, you are on mute. We cannot hear you. Hello, Danny? Danny, you are on mute. Sorry, Danny, you're on mute. I don't know if you can hear me. Hello? Ignacio, if you could tell Danny that he's on mute, we cannot hear you. Danny, you are on mute. We cannot hear you. Can you hear us? We cannot hear you, Danny. Can you
Now,
unmute?
is it working now? Sorry.
Yeah,
No,
we can hear
basically
you
here
now.
some
No.
conclusions,
Yeah, of course.
especially and basically highlighting the role of the PPA as a risk tool and well, exciting moments for the sector in Spain, challenges to be addressed, and happy to stay 5 minutes more to answer some questions. We have already answered some of them by chat, but happy to discuss 5 minutes more if you want to.
Now you are on mute, Alejandro.
Yeah, sorry. Thank you again, Daniel, Julio, and Ignacio for the great presentation you just showed us. And Danny, I see that you already answered some of the questions directly, but well, we have a couple of minutes. Uriol, if you can answer some of the remaining
Yeah,
questions.
I can answer two quick questions. How do you see this summer hydro risk? Do you see it mitigated by the big savings in reservoirs? Okay, well, the reservoir levels at the end of last year were at historical lows. Then in January we have a lot of rainfall in Spain and also in the rest of Europe. So reservoirs went back to more or less the average levels. But since then they've been decreasing. So now we are below average. But the weather.
Sorry, Uriol, we stopped hearing you for a minute there.
Okay, well, I was saying that for summer, we don't expect let's say a brilliant summer on hydro, but it looks like it won't be as low as it was in the last year. Also, less hydro production in summer also means less price cannibalization from the PV, from photovoltaic. So there's also a good side on that. But again, not as low as the last years, but they're not to be a normal hydro summer, let's say. And then another question that Daniel already answered in the chat is about the negative prices in the day-ahead market in Spain, that we are not seeing it like in the rest of Europe. Even we have the same rules, so there can be offers offers at negative prices. And right now in Spain, the Spanish market, there are only around 5 gigawatts of negative offers, and the minimum demand is around 20 gigawatts. So we are still far. So basically, as Daniel said, the dynamics of the agents in Spain is basically the low prices to be at zero, and at least for the coming years, it's the lowest prices that we are going to see in the Spanish market at zero.
So Daniel, if you can answer the last question.
Yeah, no, but very quickly, basically, what about if 10 gig of self-consumption come? Well, I take what Nacho said, and Julio or Nacho, feel free to add, but basically, the Nacho said demand is not stupid. So at some point, a massive cannibalization of the prices and a lot of €0 megawatt hour prices, etc., should act as a change maker on the other side of the coin, meaning that the more cannibalization, the less incentives to go for self-consumption. Today, we are at 5.2 giga, a market so backwardated, and the experts on prices is here my colleague. But basically, what I would say from a market design and regulatory viewpoint is that the more DAC curve, the lower prices in the central part of the day, the company should switch to those index products and daylight hours, and therefore less incentive. So my personal best bet is that now subsidies will also terminate in 2024 in principle for the next generation fund. So I think the rhythm of self-consumption in Spain should decrease, or at least ballpark best bet, personal opinion.
Yeah, at the end of the day, the cheapest self-consumption is the one installed by your neighbor. So, because at the end of the day, we can analyze the pricing by installing it. It's not need you to install it. So it's a self-consumption for free. So at the end of the day, normally the piece of this kind of facilities, or at least in a massive way, or for big industrials, should decrease.
Okay, perfect. Thank you.
That's it on our side, Alejandro.
Yes, thank you again for joining us. Uriol, Daniel, Julio, Ignacio, great presentation. And as Uriol mentioned, I invite you to register already to our next webinar that we will be held in July. And thank you again to the speakers and the audience for joining. Have a nice day.